We have Gary Kaltbaum with us. We've got Scott Martin here, Susan Lee, Ashley right next to me. What a roller coaster yesterday. So, Gary, I'll start with you. What was that all about?
Very simple. The Dow went down 1,841 points since the high of last week and has to bounce somewhere, and you're getting it. On top of that, yields had, I think, a climactic plunge over the last few days, and I think that's reversed. And they also sent 2 Fed heads out in the last 2 days to stanch the bleeding. So I think near term, probably the worst is over. Let's see what happens in a week or two. I'm not just there yet that we're out of the woods.
Okay, bring in Scott. I'm going to ask you the same question. What was that all about? You tell me.
Well, I guess a thin trade, Stuart, as you talked about or at the beginning of the show. Obviously, machines, algorithms kicking in there. And 2, I think a relative expression of really what the risks are to this market that are out there if things continue to go badly with China, if we continue to have issues other places overseas. So, to me, I would add to Gary's points, which were well put, gold, too, guys. Gold, too, is something we've talked a lot about on this show as a safe haven, as something to own because it doesn't act like stocks or bonds. That became a nice haven over the last couple of days as stocks went crazy down.
Okay, back to you, Gary, because I think you believe that the Fed is going to be dropping rates rapidly and soon. Is that's what you're saying?
They sent the 2 out in the last 2 days to stop the market from going down so they can wait till the end of September to low rates. But if the market does not cooperate and we start heading south, drop another 500 or 1,000, I think the Fed will immediately lower rates. They are targeting the market. They know the market is meaningful.
Yeah. Scott was chiming in there saying, yeah, he thinks we're going to get a rate cut right from the Fed. Yes, you think that?
I think we are, Stuart. I don't think the Fed's going to wait. And Gary's right. If the markets fall out of bed a couple more times, definitely it accelerates the probability. But I'll tell you guys, even with the bounce we've seen in Treasuries in the last 2 days, rates are still below the Fed funds rate, even on the long end of the curve. So they're being begged by the open market rates to cut.
Look, this, I hate to get technical, but this inverted yield curve, right, where short-term rates are above long-term rates, supposed to predict a recession. So, Scott, you tell me, are we going to get a recession?
I think we may get a slowdown. I don't know if it'll be a full-on recession, Stuart, which is by definition 2 quarters of negative GDP growth. But I could see a 0 print in there if things continue to struggle with China, if we continue to see weakness overseas and, say, Europe especially. So, yes, I believe we're going to get a significant slowdown. I think that's why you're seeing rates plummet, not only here but around the world.
It's normal to see a correction in a long-term and late-cycle bull market, which is what we're seeing right now. But I would say it's been encouraging. Last night you had China setting the yuan at 7 again. No reaction because we got better than expected exports for China and also better data from France, as I mentioned to you earlier. So the world is not collapsing. I think we need to keep things in perspective.
That's very good. I mean, look, we're 5 minutes into, I'm sorry, we're 4 minutes into the trading session, and we have a complete reversal from everything that we saw yesterday. And I'm not going to say back to normal, but we are back to where we were 48 hours ago. Great. Let's move on to Lyft. They reported this morning they lost less money. They booked more riders. The market likes it. It's up 8%. Nice gain there. Gary, Lyft and Uber shares still underwater since the IPO. Would you, Gary Kaltbaum, would you touch either of them?
No. Look, all we have is a company that had a gargantuan loss, but beat a bigger gargantuan loss. Just doesn't do it for me. My thought process in markets, I want to buy companies that have great earnings and revenue growth, growing their business, to actually doing something and making money. By the way, Uber, every time they drive somebody around, they lose 67 cents. Sorry, not a great business model for me.
Okay, look, Lyft, it's Lyft that's down 9%. Is that right, producer? Since the IPO, Lyft is down 9%.
They went at 72.
So, Scott, do you think that that is a buying opportunity? If you're down 9% since the IPO and you're up 8% this morning, you buying it?
I'll tell you, I think you probably missed your chance on Lyft when it actually swelled downward a little bit earlier in the month and certainly last quarter. So I think actually the opportunity here is Uber. I actually like Uber. In fact, I think Uber's got a nice diversified business model. Gary's right. They do lose money whenever they pick you up, but they've got Uber Freight, Uber Eats, and they also got the self-driving car stuff, too, that they stole from Google. So I like it better than Lyft.
Self-driving car. Right. What do you got?
So I'll be watching Uber earnings later on today. And, you know, it is subsidizing each and every ride, because I'm looking at $1 billion still being paid out in the quarter for those promotions, incentives, of course, for just to get drivers and to get market share. I think it'll be interesting to see whether or not they measure up to the Lyft metrics, which is
look at that.
higher. Yeah, higher.
That's Uber before they report.
Yeah.
They're up 6.6%.
Yeah, running up ahead of the earnings.
But it's still below the IPO price at $45. So what's important here is that they get more riders, they get more profitability, make more money off each and every ride, and they tell us that they're closer to profitability as Lyft did yesterday, accelerated.
Okay, big picture again. Now check the big board. We are up 120 points. 124 as we speak. That is a half percentage point. Rebound. Lower profit at Kraft Heinz, and that stock is hitting a record low. It's down 14% today. Better profit at Keurig Dr. Pepper. That's up just 1% and change. TripAdvisor, well, their earnings fell a little short. Nonetheless, okay, you got to explain. How is it that the earnings fall a little short, but the stock goes up 7%?
Guidance.
I mean, there's something in there that I'm not getting. I'll get it soon. Amazon and Google remove listings for sales of gun accessories. Now, that doesn't affect the stock, but in this day and age, we report that kind of thing. Amazon's back above 1,800. Google's at 1,184. Roku, they make those streaming boxes. Plug them into your TV, watch Netflix, stream on it. They gave a rosy forecast. More people gravitate towards streaming services. The stock's up 20%. Whoa. Are they a pure play in streaming, Scott?
Well, yeah, they are, and I can't believe it, actually. I mean, Roku is also up a couple 100% before today, year to date. So they're doing very well. And here's what I think it shows you on streaming, Stuart, is that the streaming world is big enough for many players. I mean, Netflix has been falling down a little bit lately, but Disney obviously is a big promise going forward into streaming. So it goes to show you that streaming is going to be big. Cable's in big trouble.
They went past, they went past 30 million accounts, average user per user, $21. They're doing very well.
And that was an all-time high.
Yeah,
that's right. Yeah, up 20% today, a couple of 100%.
Since the IPO,
okay,
yes.
Stock of the year, maybe. Who knows? Subway and Beyond Meat, they're teaming up for a meatless meatball sub. Has anybody tried...
Can it be called a meatball sub?
Yeah, is that false advertising? I don't know.
This is the stock of the year. It's up 800% since its IPO, Beyond Meat. If you're getting 20 ounces of protein in, what, 4 ounces of a patty, or meatballs in this case, I would try it.
But it was over $200 a share, wasn't it?
Yeah,
now it's 164.
It's $240.
240. Thank you.
Money.
Yeah, 240. Has anybody here tried the Beyond Meat, the Impossible Burger? Sorry, the Impossible Burger. Anybody tried it?
At Burger King?
Yes.
No, not yet.
No? No? Okay. All right. Move on.
Next.
Domino's.
I'm sure it's good.
And this is intriguing. Domino's, pizza people, stockpiling pizza ingredients ahead of Brexit. What?
Yeah.
They are. But look, this is
it's a long way in advance, isn't it?
It is. Well, October 31st
Doesn't the cheese
and
go
beyond.
off?
Well, yes, it does. Well, they get their flour and cheese inside the UK. We're talking about frozen chicken, pineapple, tomatoes from Portugal, those kinds of things that they're saying, well, if we crash out on October the 31st, we may have trouble getting this stuff. So they're stockpiling. Other companies are doing the same thing. Medical companies are starting to stockpile stuff that they get from the continent. So fear-mongering, maybe. Smart planning, maybe. But there you go. Even Domino pizzas.
Hey, Gary Kalbaum, I think you're still there. I'm sorry I referred to you. I'm very sorry, Gary. What do you got on Brexit? If they exit with no deal October 31st, do we suffer? What do you think?
I think everybody suffers. You can't do a Brexit with no deal. By the way, we're more than 3 years beyond the vote.
Yes.
I mean, what the heck happened over there? Oh, Theresa May. Look, a no deal is bad news. You've got to get some sort of deal. Why it's called semblance of order. When you're that big of a country and you have that big a trade with so many other places around the globe, no deal, bad news. And the reason why you're seeing these the stockpiling is good planning by companies. You're going to see a lot more of that as we move forward, especially if a no deal.
All right, it's 9.
I'm selling the pound.
You'd what?
Selling the pound. Yes.
I'm selling the pound. I'm telling you guys.
Yeah.
It's getting cheaper to go to the UK.
It's getting very cheap to go to London right now.
Maybe I'll go back for a couple of weeks or something. Who knows? It's 9:40. You know what that means. Goodbye, Gary and Scott. Thanks for joining us. We appreciate it.